I'm sure most high-level executives would not agree, at least in public, with what I'm about to say, but that isn't going to stop me. Here it is. When a public company has unpleasant information that it is obliged to divulge to its shareholders and would prefer not to be questioned about it, they will often bury it in the notes of the financial statements, if at all possible, which means if their auditors will allow them to. Clearly, not all companies do this, but many do. That's just one of the many reasons savvy investors and others devour the notes to the financial statements with great relish, and you should do the same. Before we get to the reasons why you should read them in great detail, let's start with some basic definition. What are notes to the financial statement? Some call them the fifth financial statement in addition to the income statement, balance sheet, cash flow statement, and statement of retained earnings. These notes that accompany financial statements are often as vital as the other financial statements mentioned. They often provide critical information that will not be found on the balance sheet, income statement, cash flow statement, or statement of returned earnings. And by the way, retained earnings is sometimes referred to as owner's equity. Notes can include text, tables, graphs, and explain financial details about a company, such as when revenue is recognized or how write-offs are calculated. This information is critical as small differences in revenue recognition and the calculation of write-offs and reserves can easily turn profits into losses. If you're researching for a company to invest in or trying to get a better understanding of one that you've already invested in or are doing business with, notes are helpful when evaluating a company's financial performance and strength, as well as any risks that you should be aware of. Lenders will also be concerned about future potential risks, as it could impact their ability to be paid when their loan matures. Let's look at some more reasons for you to read the notes. Reason number one, is it a going concern? Financial statements are prepared on a going concern basis, which assumes that the company will continue in operation for the foreseeable future and will be able to pay its liabilities, such as employees' wages, in the normal course of business. They follow the guidelines laid out by GAAP. When doubt exists about a company's ability to continue as a going concern, details will be disclosed in the notes, but you have to look for them. It could include information about the underlying reasons and information about its future vulnerabilities and overall risk. As you might imagine, this might be reason enough to dive into those notes without the other reasons we're going to discuss. Reason number two, have there been any changes made to the company's accounting policy? Almost all figures reported in financial statements are affected by the company's accounting policies. Even a small change in that policy can impact financial results. For example, changing revenue recognition policies could increase or decrease the reported amounts of revenue, net income, and accounts receivable. If such a change is not disclosed, comparing financial results year to year between similar companies would be difficult, if not impossible. Reason number three, are there any future commitments and/or contingencies that will seriously impact operations? Some commitments, for example, unfulfilled purchase orders or potential obligations, i.e. pending lawsuits or disputes, are not recorded in the financial statements. A commitment or contingency may result in a future liability, i.e. a cash outflow, depending on the outcome of certain events, such as an unfavorable legal judgment against the company. Until that time, the items remain off balance sheet and unrecorded. In order to appreciate the nature and extent of risks associated with these items, as well as the impact on future cash flows, the notes can reveal important information that you should be factoring into your analysis. Until there is more information or certainty, these items will remain off balance sheet. That being said, the notes may provide clues on the company's expectations of these future events or outcomes based on whatever limited or incomplete information they have. Reason number four, were there any one-time events or transactions that impacted the company's operations and financial bottom line? A company could have had a transaction or event that may be considered distinct, unusual, or otherwise unique compared to its normal operations. Examples would include, for example, an unexpected loss due to a natural disaster or the sale of a part of business. This might lead to an unusually high or low income or expenses compared to previous periods, and of course, if it's not likely to happen again. When assessing a company's financial performance, make note of distinct and unusual items that may not be repeated in the future. This could significantly influence financial results for that given period of time. It is one of the reasons financial advisors always caution that past performance is not an indicator of future performance or guaranteed results. Reason number 5, were the estimates made in the preparation of the financial statements reasonable? The preparation of financial statements requires a company's management team to make estimates and judgments that affect reported amounts. For example, management may need to estimate the uncollected amount for outstanding receivables for bad debt. Some organizations estimate on the high side, not wanting to overstate income. Others do just the opposite. The application of different estimates or judgments could lead to significantly different financial results. This does not mean that the financial statements are not dependable, but rather that the financial statements should be approached with a sense of their underlying characteristics and understanding that things they depict could have been measured differently by using other, often equally reasonable, estimates or judgment calls. Understanding these key accounting estimates and judgments can help you better assess the numbers underlying a company's financial position, its performance, and gauge, to some extent, the reasonability of these estimates or judgments, taking into consideration your knowledge of the company, the industry, and other external pertinent information. Reason number 6, do you have a good understanding of the company's revenue? Notes can give details about where revenue comes from, payment terms, amounts allocated for refunds or warranties, and other relevant information. Revenue isn't necessarily the same as cash collected, so it's important to understand how it is affected by the company's accounting policies. Reason number 7, what are the organization's current debt obligations? To understand the extent of risks, including future cash outflows arising from debt obligations, and how a company manages these risks, the notes can reveal information such as repayment dates, which could be problematic if interest rates have risen and or the lender is unwilling to roll over the loan into a new one, and no other lender appears willing to step into the place of the original lender. Demand for repayment could cause serious cash flow issue. Terms on outstanding debt, including the interest rate and whether there are any conversion features. And if it's an adjustable rate, then that needs to be taken into account also. Access to unused credit, i.e., are there credit lines that are not fully drawn down, or are they fully drawn down? Assets that are pledged as security, and in which case they can't be sold or used for other purposes. How the recorded debt amount compares to its fair market value. Reason number 8, are all loan covenants currently being met, and what are the consequences of non-compliant? Typically, loan covenants are not a huge deal for an ongoing business, but when it gets into financial difficulty, they have a potential to become a huge nightmare and potentially get a loan called early before its maturity date. So important to focus on that. Reason number 9, are there any related party transactions? And if so, how do they impact the financial viability of the organization? In an extreme case, especially when two organizations have different fiscal year ends, income could legitimately be reported in two different places, the same income. Related party transactions are between parties that they can influence each other, like the sale of equipment between two companies owned by the same person. The price or terms may be more favorable compared to transactions between unrelated parties. The notes can reveal important information on related party transactions, including outstanding balances and commitments. This information can help you identify certain transactions for further assessment, commentary, or consideration. Since related parties include key management personnel, the notes are also a place to look if you want to know compensation for this group. Reason number 10, are there any known subsequent events that will impact the financial viability of the organization. A subsequent event is an event that occurs after the stated reporting period of the financial statements, but before the financial statements are authorized for issue. Although certain subsequent events may not be recorded on the financial statements, information regarding these events should be disclosed in the notes. Then it will make a material difference. Some examples might be a planned acquisition, new guarantee or commitments, new planned financing, i.e. sale of shares, debt financing, etc. Information on such events provides early notice of these events and that this will affect future financial statements and allowing for you to incorporate them into the analysis today. We've mentioned balance sheet and income statement several times in this talk. Some people get them mixed up. Click on the link that has appeared on your YouTube screen and is in the description to ensure you understand the difference. Good luck.